Okay, let's just dive right into this explainer and demystify exactly how you can build life-changing wealth literally from scratch. Look, if you've ever heard everyone tell you can just put your money in index funds and thought, okay, great, but like, which ones? Or maybe is my $5,000 too small to even start? You are in the exact right place. We're gonna break down how to navigate this whole thing without any of the guesswork. But before we get into the nitty-gritty mechanics, I've got a question for you that really highlights the incredible stakes we're talking about today. What if a single $5,000 deposit could transform into over $733,000 with absolutely zero extra contributions? I know, it sounds like magic, or maybe a late-night scam, but it's actually just math, time, and some strategic fund selection. So here is our step-by-step playbook for today. First, the investing foundation. Second, 3 filters for choosing. Third, the starter portfolio. Fourth, the 3 golden rules. And finally, the aggressive growth path. Let's kick things off with section 1, the investing foundation. To start, we really need to establish where our proxy beginner, let's call him John, is going to put his money. We have to define what an index fund actually is and why it is infinitely safer than risking everything on one single company, like Boeing, for example. If John buys a single stock and that company has a brutal few years, well, his entire investment absolutely tanks. An index fund, on the other hand, is like a giant basket. He buys one single share and he instantly owns a tiny slice of hundreds of companies. If one fails, the rest carry the weight. Now, there are 2 main baskets you can choose from, ETFs and mutual funds. While ETFs trade all day long just like regular stocks, mutual funds settle only once a day at a set price. John is going to choose passive index mutual funds. You can kind of think of them as the crock pot of investing. You just set it, forget it, and let it passively track the market without paying those hefty 1.5% fees that active money managers love to charge. Moving right along to section 2, 3 filters for choosing. So, how does John avoid just wildly throwing darts at a board among thousands of options? Well, he uses 3 super strict filters. First, the expense ratio has to be under 0.3%. Even a measly 1% fee can eat up hundreds of thousands of dollars over a lifetime, so we are keeping costs near zero. Second, he needs to know exactly what index it tracks. And third, 0 minimum investment. John is specifically seeking out Fidelity funds because their 0 minimums keep the door wide open for his $5,000. This is a big deal, unlike other brokerages where the cheapest funds are often locked behind $3,000 gatekeeping minimums for just one fund. The actual mechanics, they literally take 3 simple steps. Open the account, fund it, and buy. But that second step is absolutely critical. Turning on automatic dividend reinvestment, which is often called DRIP, is the ultimate secret to free compounding. Every single time a company pays out profits, instead of that money just sitting there as lazy cash, it automatically buys John more fractional shares. It creates this snowball that grows faster and faster entirely on its own. All right, on to the fun stuff. Section 3, the starter portfolio. Now we actually put that $5,000 to work. And the crucial point to remember here is that every single dollar needs a specific job. First up, we have FXAIX, which tracks the S&P 500. Its job is absolute baseline stability. Next is FNCMX, tracking the tech-heavy NASDAQ composite. Its job is aggressive growth. And finally, FTIHX captures thousands of international companies, providing geographic balance so John isn't solely relying on the US economy to succeed. By deploying his $5,000 across these 3 specific funds, John captures the absolute perfect blend of growth and geographic coverage. Half goes to stability, 30% to growth, and 20% to the rest of the world. He buys this exact ratio just once, and boom, he is instantly fully diversified against almost any economic storm. Which brings us to section 4, the 3 golden rules. Getting the money into the account is the easy part. Surviving the emotional reality of the stock market, that is where most beginners completely sabotage themselves. To survive entirely normal 20 to 30% market crashes, and by the way, those are a feature of the market, not a bug, John strictly lives by 3 golden rules for the next 30 years. Rule 1, he never panic sells. Rule 2, he lets his dividends snowball. Rule 3, he only opens his app once a year to rebalance. That's it. True wealth is built through hands-off, absolute boredom. Let's watch how this discipline actually pays off. Tracking John's single deposit as that magical snowball of compounding pulls its weight decade after decade. Year 1, kind of underwhelming, to be honest. But by year 10, he's nearly quadrupled his money. And just consider the massive, exponential jump from year 20 to year 30. That is the raw mathematical power of compounding in its late stages. Just let that staggeringly huge number sink in for a second. Over $250,000 created from just $5,000, extreme patience, and zero extra contributions. Out of that $262,000, John only sweat for the first 5. The market and his reinvested dividends did literally all the rest of the heavy lifting. Now for Section 5, the aggressive growth path. What if John wants more? What if he's perfectly willing to take on severe volatility to get it? I mean, what if $250,000 just isn't exciting enough? For the aggressive investor, we do a swap. We take out our safe international balance fund for pure concentrated exposure. Out goes FTIHX, and in comes FSELX. This fund exclusively buys companies making the actual semiconductors that power our phones, electric cars, and the entire global AI infrastructure boom. Now, I have to warn you right now, this actively breaks our earlier rules. It has a high fee at 0.69%, it's actively managed by humans, it's highly concentrated in just about 60 companies, and man, it falls brutally hard during market panics. I'm talking losing nearly 50% of its value back in 2008. But its historical average annual return is a massive 24.5%. It is terrifyingly volatile for sure, but the upside is just undeniable. To accommodate this, our whole strategy shifts. We lean heavily into aggressive growth and tech innovation while slightly reducing our stable anchor. FXCIX drops down to 40%, the NASDAQ fund moves up to 35%, and our brand new semiconductor fund takes a bold 25% slice of the pie. Now, watch what happens to the math over 30 years when we introduce that kind of concentrated risk. The distance between this and the starter portfolio becomes literally impossible to ignore. By year 20, he's sitting at over $140,000. And by year 30, the explosion of concentrated tech growth pushes the envelope into an entirely different stratosphere. That is an unbelievable $471,000 gap. And it was created from the exact same starting amount in the exact same time frame just by making one high-risk decision. Same $5,000, same 30 years, radically different outcome. But ultimately, you really have to ask yourself if you have the emotional discipline to survive the terrifying red screens required to chase those aggressive millions. Because make no mistake, the market will drop, and this aggressive portfolio will plummet 30, 40, or even 50% in bad years. So do you have the stomach to hold the line, follow the golden rules, and just let time do its work? Because that's the real test of an investor. So what kind of investor are you going to be?